Hi everyone, it's Jack back with another video, and today I'm going to be talking about Medical Properties Trust, which is a real estate investment trust that primarily, you guessed it, buys medical properties, healthcare facilities, acute care facilities, care homes, etc. There's a couple of reasons why this business is interesting. One, a 15.4% dividend yield. That is of course because this business had been battered over the last year and maybe a bit longer. 64% down in the last 12 months, 35% down just since the start of 2023. And that has resulted in multi-year lows of $7 in the stock price and a 15% dividend yield, which is obviously exceptionally large even for real estate investment trusts famous for the dividends. Now I want to get into the reasons why this stock is under so much heat and then analyse whether this is a buy, sell or a hold going forward, in my opinion, by looking at its results and its forward-looking outlook. The scale of the negative sentiment against this business is best shown by looking at the short interest, and as the most recent data, which is the 14th of March, so only 2 weeks ago, the short percentage of the float is almost 29%, which is really staggeringly high and is often reflected of a business that pretty much unanimously people think is in deep trouble or looking at going bankrupt, or at the very least its earnings are going to take a massive hit, which is not necessarily what I believe to be the case here. First up, I want to take a quick look at the dividend. This company has, over the last 10 years, increased its dividend payout quite a bit, not blowing the doors off by any means, but increasing your payout from around 40 cents in 2014 or 2013 to now over $1. That is a decent return on investment, over 150% gain there in terms of dividend yield or dividend payout. I think that's pretty impressive. Over that time, they've generally steadily also increased adjusted funds from operations, which is a key metric for REITs. Free cash flow right now is not looking like it's going to be enough to cover the current dividend at the yields we're looking at. That's 15% yield, is the highest it's ever been by some distance. It's typically in the 5 to 7% range. Obviously, because of the dramatic fall in the stock price, the dividend yield has rocketed up. And at the current payout, with a couple of the problems this business is having, it's looking like the current free cash flow is not going to be enough to cover it unless some pretty big changes happen. Next, I want to look at some portfolio information, specifically the largest tenants for this business, which the top three are Steward Healthcare, which is a US-based acute care provider, Prospect Medical Holdings, and Priory Group, which is a UK-based more on the behavioural side, essentially rehab. The top two are real concerns here, Steward Healthcare and Prospect Medical Holdings. Steward Healthcare, in 2022, there's a number of Wall Street Journal articles with allegations that the company overpaid in its acquisition of Steward Healthcare to help them pay down debts, so that they deliberately overpaid, which of course the business has denied, and they are allegations, and that is it. So it's all allegedly, and that again, allegedly executives were paid based on the volume of acquisitions they were doing. That is obviously terrible. We don't want to see executive paid based on volume of acquisitions. We want them to be making quality acquisitions for the right reasons rather than just doing it to fulfill quotas so they get paid more. Again, allegedly, but I just don't like this, allegedly or not. That is not something that sits well with me. And Prospect Medical Holdings, perhaps more worryingly, the second largest tenant, is struggling at the minute. The Pennsylvania-based hospitals have been struggling for some time. It doesn't look like a particularly strong portfolio asset at the minute, and they've missed rent a couple of times in 2023 already. That is an absolute no-no for a real estate investment trust. Many real estate investment trusts that I prefer to invest in often have tenancies where rent is pretty much guaranteed and they have 96, 97, sometimes 99% occupancy, fully occupied. This is not good enough when a major constituent of this business, around 10% of the portfolio, is missing rent and could default on its payments essentially. That is certainly worrying. On the brighter side, the company is reasonably well diversified by geography. Of course, the majority of this business is done in the United States. 61% of its properties are in the United States. Of course, the United States is extremely large, has a very large population base, and it is relatively well diversified by state. And of course, this is a US-based business, but they are increasingly moving internationally. 39% of the business is done internationally, with 21% in the United Kingdom and across many other geographies, which they are expanding as they see value worldwide. I think that is a completely sensible thing to do. Couple of big red flags for me in the company's most recently released earnings, which is the financial results for 2022. For the 3 months that ended 2022, so the holiday quarter essentially, the company made a net loss of 24 cents per share. That's swinging from the previous year 34 cents of earnings, and for the full year still made 150 of earnings, which is decent, don't get me wrong, and a big increase over the year prior. But a net loss moving forward is not good. That's what I will assume is going to happen continually. That is really, really not good. Rent billed for that quarter was down around 10% year over year, and while for the full year it was essentially flat on a revenue basis and rent bill was up slightly, for the most recent quarter total revenues were down around 5% and rent down around 10%. This is really not good enough. It's a relatively hostile environment in my opinion for REITs right now, with rising interest rates around the world. This is tough, like they're taking losses on an earnings per share basis and rent is decreasing, with the prospect of Prospect Medical not being able to pay its bills going forward, which is around 10% of its portfolio. This is not good news for this business. This hostile environment for REIT with higher interest rates has hurt a lot of them in terms of asset prices. Property prices have fallen, house prices have fallen because of higher interest rates, and that is affecting REIT in a big way. Many of them have took significant hits to the stock price because of lower asset prices. That is not really the case here as much. In the quarter end in 2021, or the year end in 2021, 20.5 billion of assets. This year, 19.7 billion of assets. That's not the end of the world in my opinion. Single digit loss in asset value against a backdrop of higher interest rates and a total liability is decreasing. That's decent performance on this front in my opinion, given the hostile environment. But the concerns with rent are still there, and that is a big concern in my opinion. There are definitely attractive qualities about this business. For one, the dividend yield at 15%, even if this is decreased somewhat because of its inability to pay it, it's still likely going to be above 10%, which is a fantastic dividend yield for any investor. And it's essentially, right now, the business is being priced as if it's going to go out of business. And I think there is large potential for short squeezes to happen on a little bit of good news, and this stock could rocket. However, when I look at around in the REIT space, I think it's not that hard to get between 6 and 10% dividend yield with a much better portfolio than this business. The fact that Prospect Medical is really struggling on its rent at the minute, or as most recently as I've seen, is very concerning to me. About 10% of this business's assets. And in addition to that, the allegations around Steward Healthcare, them potentially overpaying or allegedly overpaying, those Wall Street Journal articles, they're all concerning. And while I think this stock price decrease is a little overblown, I definitely think this is an investable business, but it's not a business that I will be investing in, because I'm just not comfortable investing in this. I think there's much higher quality REITs that are available at much better prices for their asset portfolio. With that being said, none of this is financial advice. More than happy to be proved wrong with this one. I think I may be in the event of a short squeeze. You let me know in the comments down below what you think of this business, whether you think it's a buy, sell or a hold moving forward. Comment down below, like and subscribe and enjoy the content. I'll see you again next time.